Good day, viewers. Welcome to another episode of Financial Accounting Made Simple. Today, we will be looking at the methods of depreciation. Under the method of depreciation, we have so many methods in depreciating assets. These include the straight line method, the reducing or declining balance method, the sum of the year digits method, the sinking fund method, machine hour method, revaluation method, and so on and so forth. But here today, we will be looking at the straight line method. When we are talking about the straight line method, this is a method that allows equal amount to be charged as depreciation for the useful life of an asset. This method is also known as the fixed installment method because it's charged constant amount or equal amount throughout the useful life of the assets. Now, we have methods in solving questions when it comes to depreciation of assets. We have two methods that we majorly use, which we call the old method or the new method. And sometimes they can call it method A or method B. Method A is referred to as the old method, and method B is referred to as the modern method. In our videos, we will be applying the two methods. For method A, it consists of the following four accounts: asset account, depreciation account, P&L account, and balance sheet. Which simply means, in the old method, we are expected to prepare four ledgers. Ledger for the asset itself. We are going to prepare account also for depreciation. We prepare account for profit and loss account, and we prepare our balance sheet, which will show the statement of our assets. Here today, we have prepared our depreciation schedule. Remember that in our last video, we made mention of depreciation schedule as a tool that is used to track and document the decline in the value of an asset. So on the bond here, we have the depreciation schedule showing the years, the cost of the asset, the depreciation charge, the accumulated depreciation, and the book value of the asset. There are two ways in preparing this schedule. We can prepare a schedule where we have the book value at the beginning, the depreciation charge, and the book value at the end. We are also going to look at the second method of preparing depreciation schedule in our subsequent videos. Let's quickly look at the question we have over the board. The cost of a motor car is 3,000 naira. The scrap value is estimated as 200 naira, while the estimated useful life is 4 years. Use the straight line method to prepare the necessary account. So using the old method, you are going to prepare 4 ledgers. You are going to prepare ledger for the asset account itself, which is the motor car account. You are going to prepare ledger for depreciation account. We are going to prepare for the profit and loss account, and we are going to prepare the balance sheet. So looking at what we have there, it is good to know that for straight line method, it has a formula that you can apply, which is cost minus residual value divided by the estimated useful life. Kindly note that the estimated useful life can also be written as useful life or number of years. So, whenever you are given a question with respect to straight line method, you are to watch out for all these variables: the cost, the residual value, and the estimated useful life. If we look at our question here, the cost of our asset, which is the motor car, is 3,000 naira. The residual value, which is the scrap value, is 200 naira. And we have been given the useful life as 4 years. So all we need to do now to determine our depreciation charge or depreciation expense per year is to fix in all these variables into these formulas. So I'll come to this egg to pull the variables as my cost, which is 3,000 naira, minus my scrap value, which is 200 divided by 4, which is a number of years and it's ready to depreciate the assets. So 3,000 minus 200 will give me 2,700 divided by 4. When I divide 2,700 by 4, I'm going to have 700, which simply means 700 is my depreciation charge. So 700 is my depreciation charge on yearly basis. So all we need to do now is to come to our depreciation schedule and fix in all the years. The number of years is just 4, 1, 2, 3, 4. And the cost of our asset is 10,000, the cost of our asset is 3,000 naira. The cost of our asset is 3,000 naira. Naira. And our depreciation charge is 700 for each of the year, which is very constant. Since you are using the straight line method, we are going to charge equal amount or fixed amount. And what we mean equal amount or fixed amount, which simply means the depreciation charge for each of the year will be constant. 700, 700, 700, 700 for each of the year for 4 years. So all we need to do is to bring out our depreciation that we have here to accumulated depreciation. So to accumulate this depreciation, we are going to add our depreciation for year 2 to depreciation for year 1 to have 1,400, where we add our depreciation for year 3 to depreciation year 2, we are going to have 2,100, and then when we add our depreciation for year 4 to depreciation year 3 to give us 2,800. So we are expected to charge at the end of year 4 to have charged 2,800 as our depreciation. So to get our net book value for year 1, we take away 700, which is our accumulated depreciation, from the cost, which will give us 2,300. For year 2, we take away 1,400 from 3,000. That will give us 1,600. From year 3, we take away 2,100 from 3,000. We are going to have 900. And for year 4, we take away 2,800 from 3,000. We are going to have 200, which gives us back our scrap value. If you are working your own and you are not having the scrap value back, it means there's an error somewhere. You need to go back and recheck what you have done. So by the time you finish preparing your depreciation schedule, you are going to have your scrap value back, which is what is given to you in the question. Now we have prepared down our ledgers. So we are going to post all the information we have in our depreciation schedule into our ledgers. So We are moving to the ledgers now. We are going to prepare ledgers for motor car account, for depreciation account, for profit or loss account, and we're also going to prepare ledger for the balance sheet. So starting with the motor car account, we have year 1, January 1st. This is when we bought our motor car. So we are paying by cash. The opposite of this account will go to the cash book on the parent side. So here we have 3,000 as our value. Mind you, the accounting procedure in preparing this account is to debit the asset account with the cost of the assets and credit the asset account with the depreciation charge. We debit the depreciation account with the depreciation charge, and we debit the P&L account with the depreciation charge and credit the depreciation account with the depreciation charge coming from the P&M account. So here we are going to have 31st December depreciation. And our depreciation value is how much? 700. So we have 700. After imputing our depreciation, we have computed our depreciation value and we have added the value of our asset. All we need to do is just a circular arithmetic by taking out our depreciation from the cost of our asset to have our book value. Well, instead of doing all those mathematics again, we can just come directly to your depreciation schedule and pick all the information needed. So for year 1, our book value is 2,300. 2,300 will be given when we take away 700 from 3,000. So this could be our balance carry down. So we close this account by adding up these two to give us 3,000. 3,000. So for every balance carried down, we have the balance brought down. So this will be for year 2, January 1. Balance brought down, which is how much? 2,300. So the depreciation charge will be 31st December. Depreciation 700. So depreciation 700 for the second year. When you take away 700 from 2,300, you are going to have 1,600. So our balance carry down will be 1,600. So when you add up this side, we add 0, 0, 13, 2. So we add 2, 3, 0, 0. So we close the account. So for year 3, we have general reports. Balance brought down, which is 1,600. More 1,600. So we have 31st December depreciation. 700. If you look at it, we are charging 700 on yearly basis. Why are we doing that? Because the method they adopted is a straight line method, and it charges an equal amount throughout the useful life of any asset that you are looking at. So we had 700 minus 1,600. This is going to give us 900. So we have 900 as our balance carry down. So when you add some of this, you have 1,600, you have 1,600. So we have for year 4, January 1st, balance wrote down, which is 900. 900. We have our balance brought down 900. So we have 31st December depreciation, which is 700. So I'm going to have the difference between my balance brought down and my depreciation value is going to give me 200, which is my balance written. So when I add up the two, 700 plus 200, we give me 900. I will use that to close my account. And I will close my account also with 900. So I have 200. So at the end of year 4, it takes me back to my scrap value, which is 200. The same thing you have in our depreciation schedule. So everything we have in the depreciation schedule is what we also have here. So the next thing to do now is to prepare our depreciation account. So we are preparing our depreciation account. Depreciation account. So for our depreciation account, we are to debit our depreciation account with the depreciation charge and credit our asset account, and that is what we have here already. So the opposite of this is to just come here for year 1, we have motor car. That is as an account we are recording from. So we are posting from. So we have motor car, we have 700 year 1, motor car for year 2, 700, year 3, motor car, 700, and year 4, motor car, 700. So this way, we are posted to our depreciation account. So we are going to prepare the remaining 2 accounts, which is our P&L account and our balance sheet. So here, we are coming back here to prepare our P&L account and our balance sheet. So profits and loss accounts. See. Sorry. This is financial secrets. It doesn't have a, so this is a balance sheet. It doesn't have credit and debit. Balance sheet. So, for our P&L account, we are to debit the P&L account with the depreciation chart on yearly basis. So, for P&L account, we are going to have year 1, depreciation, which is 700. Year 2, depreciation, 700. Year 3, depreciation, 700. Year 4, depreciation, 700. So having done this, we've completed the posting that will go to the depreciation account. And also, we have to complete the double entry of base by costing the opposite side to the depreciation account itself. So we come here, we have year 1, P&L account, 700. Year 2, P&L account, 700. Year 3, P&L account, 700. Year 4, P&L account, 700. So in doing this, we have completed the posting into the depreciation account. We are now going to prepare the balance sheet. So in our balance sheet here, all we need to do is to bring in our assets and bring in our asset, take away the depreciation to know the book value of the asset. So for year 1, we have motor car, which the cost is 3,000 naira. So you less depreciation of 700 naira. If you take away 700 from 3,000, you are going to have 2,300, which is our book value. And this book value is what we are going to charge to the second year. So they have for year 2, motor car, 2,300 less depreciation, 700. If you take away 700 from 2,300, you are going to have 1,600. Year 3, motor car, we are bringing out the book value again, 1,600 less depreciation, 700. So if we take away 1,600 from 700, we are going to have 900. But for the last year, which is year 4, they have motor car, 900 less depreciation, 700, and we have 200, which will give us the scrap value of our assets. In doing this, we have completed the preparation of this account using the straight line method and using the old method. In our subsequent videos, we'll be using the second method, which is the modern method, in preparing our assets account. Thank you for listening. See you in the next episode.